Hey, everybody. Welcome to today's Tech Talk Tuesday. I'm Rachel, and with me today is David Blake. David, how are you?
I'm doing well, thanks. Thanks for asking.
Awesome. Let's jump right in with how last week's market went with a look at last week's market ladder.
Well, we had another volatile week in the stock market. The stocks were battling soaring rates, higher oil prices. We had another strong week in the U.S. dollar, which has been up, I think, 10 weeks in a row now. And that was against the backdrop of better than expected economic data. Jobs data was strong again. Inflation data actually was kind of mixed. And the major averages were kind of whipped higher and lower before we closed the period, with S&P 500 down for a fourth consecutive week. The Dow was down for the second time in 3 weeks, I believe. And NASDAQ actually eked out a small gain. If you're wondering why that is, we are having a very strange thing that's been going on for a while, where rather than going towards utilities, consumer staples, and some of the what are considered defensive sectors, uh, people are choosing to go towards the big cap tech. They have lots of free cash, and they just think that the downside is going to be less on those stocks and some of the others. And in fact, with the way the rates are rising here, utilities, REITs, and consumer staples are now some of the worst sectors in the whole market. Which again, normally when you're having a market that's going down, people go to those to get some dividends and stuff like that. But we're not seeing that at this stage. So that's why the NASDAQ actually eked out a little bit of a gain. I think it was up, what was it, 7 points last week. So not much of a gain, but that's why it's a little bit out of the ordinary. Now, today, we are seeing that reversed. In fact, today, the NASDAQ's down almost 2%. And the QQQ, which is the big cap tech stocks, is also down about 1.75. So getting a little bit of a sell everything type of thing going across the market right now. Okay, we had the Dow Jones give up the 200-day moving average last week. That was the first time that that's happened since March. And surprisingly, today, it's down another 420 points. And as of right now, the Dow is actually down 100 points for the year to date. So this little sell-off here in September has wiped out all the Dow's gains. The NYSE, which is a little bit broader, less weighted, is about almost even. I think it's up about 100 points. And the small cap Russell 2000 is also down for the year right now. You still have some gains on the S&P 500 and NASDAQ. We'll see if that starts to pick up here later on in the month. We had stocks gapped higher on Friday after the August core-PCE index came in a little bit less than expected. It was only up 0.1% and 3.9% year over year. And that was down from being up 4.3% the prior month. But that gap higher did not last. With the jobs rate going on, and you just had more Fed officials coming out saying that to get that inflation down to their 2% target, you're going to need to raise rates. Now, um, at this point, we're looking at probably we're a couple of days ago anyway, on Friday, it was about an 83% chance that they would leave rates unchanged in October. I mean November, the November 1st meeting. That has now come down quite a bit. In fact, I think today we were somewhere at about a 30% chance, 34% chance that they would raise rates a quarter of a point. And in fact, today with the 10-year Treasury is actually above that. It hit 4.75%, which is the high range of where a rate hike, a quarter point rate hike would be. So I did notice today also you had the Fed's Cleveland Fed President Mester. She was out saying that she supported another quarter point rate hike. And yesterday we had another Fed official saying that he wanted another quarter point hike. So the market's not taking that too well. Most analysts already think that the Fed's going too far, too fast, and they want things to kind of settle down in here before and just let the rates work their way through the system. We'll see how that goes. We did the last couple of days see a little bit of a pullback in crude oil prices. I think part of that was just some profit taking. Energy was the only sector that finished positive in September. So despite this little bit of a sell off, I think you'll probably see oil prices go higher. One of the reasons why it's selling off is that there's an OPEC plus meeting tomorrow. I don't think that will have much impact. I don't think that anyone's looking for any surprises out of that. But I think that with the rates going higher here in Europe and around the globe, basically, there's concerns that we could go into recession fears are starting to bump up again. For a while there, we were getting some rally on hopes of a soft landing. I'm not in that camp really at this point. I think that we'll probably see more of a slowdown than what we're going to get. So, as the week ended last week, we had the technical condition of the market was still weak. I wrote that if this week we didn't see the market, the Dow take out 33,306, that we could see some of the cycles reset in the CTI, but that 33.3 level was broken yesterday, and again today we actually broke 33,000 for a little bit. So we'll talk about that in a minute. We are oversold. I mentioned that last week by several measures. The MarketEdge S&P short range oscillator, the SRO, finished last week at about minus 4.97. I think yesterday we were at I think almost 6.5, and we'll probably crack. We could crack down to 8 or 9%, which you'll start to see that. Some people start to look at that as maybe starting to look at some stocks that they may want to go into. They'll look at different moving averages. I think at this point, if you look at the 200-day moving average for the S&P 500 and NASDAQ, you might see some buying coming in at that stage. If you would go a couple days where you would bounce along that and hold that support level, you could get some short covering coming in here. I'm not too sure on that yet. The indicators are still very bearish. Something I looked at last week, we did see a little bit of positive divergence in some of the secondary indexes, which I look for to see whether or not they're going to lead the market higher or lower. And as they kind of settled down last week, I thought, well, maybe we can, if we start to see those start to outperform a little bit, maybe we're starting to see signs that we're close to a bottom. But that has that's kind of gone away this week. We're not, like I say, even those indexes are down. I think the 200 is below the 200-day moving average. We're actually also close on the NASDAQ and the SOX, the semiconductor index, of the 50-day crossing below the 100-day moving average, which is another just a reminder that the intermediate term trend is now lower. Well, I talked last week that despite the fact that we had a head and shoulders chart breakout in the Dow Jones, that would set up a target for that index at 32,750 to 32,800. That's the downside target for that. And today we hit 32.9 something. So by that index and that measure, we could be getting again closer to a bit of the index finding support. The S&P 500 also has a head and shoulders target. It's not as pronounced as the Dow, but if you want to draw that in, you probably see you could actually see a 4,100 to 4,120 target on that, which would actually be about 100 points or 700 points or so lower on the Dow. I don't know about that. The 200-day moving average is at 4,200. That's where the bellwether index, we could see it align with the 200-day moving average to try to find some support. Again, if that and the NASDAQ go down there and can bounce around that for a couple of days, you might see some short covering, which could move the stock up, the indexes up a little bit higher. But you've got to see these rates just kind of settle down a little bit. I mean, if you look at the chart, it looks like the chart on NVIDIA going straight up from the lower left-hand corner to the upper right-hand corner. And I believe rates are up something like 20, 22, 25% over the last several months. So that's something you don't normally see. It's historically something that they'll be talking about later on when we find out how this market reacts to the rates going up that high. But until the rates settle down, there's no reason to be jumping in here trying to catch a bottom. Again, like I say, you may have some stoppage around that target on the head and shoulders around 32,750 and then around 4,200 on the S&P, but I wouldn't be real excited to be jumping at that point. Underlying breadth is still weak. The NYSE advanced decline line and the NASDAQ are losing ground. I did mention that it had also bottomed last week on the NYSE, but it's taken that out significantly here in the last day or two. So that is possibly indicating maybe we're close to a bottom, kind of got wiped out. One of the things, if you watch that AD line, generally you will see it's pretty well known that the AD line will you generally bottom out. It could be a month or so before the market actually finds a bottom. So as kind of keep an eye on that. If that firms and we start to see it tick up while the market's kind of bouncing around the bottom, that would be a sign of positive divergence that again, or maybe we're closer to a bottom. So we'll watch that. As far as the momentum goes, the MarketEdge Momentum Index is at a -10. It ticked up a notch last week, but nothing else really looks good. I mean, you had with the NASDAQ, you actually had only about 526 units were lower. That was a little bit surprising because yesterday, with the advanced decline lines, it was almost 2.5 to 1 decliners to advances on the NASDAQ with that, as you watch that, and the NASDAQ was up. So despite it being up again, it was oversized gains in the big cap where they're going into that for safety. And then today, for some reason, they're the rest of the majority of stocks were down, but then today they're selling off the big cap stocks too, and that's causing the NASDAQ. The Microsofts and Apples and Nvidia, Google, or Alphabet. They've been holding the NASDAQ up, almost all summer and giving it the outperformance. And we've mentioned several times that if they start to sell those off because of that overweighting on those stocks, you're going to see the NASDAQ fall faster than the blue chips at this stage. So we'll keep an eye on that. Sentiment was actually neutral last week on our sentiment index. I imagine you'll probably see that go into a negative rating at this within this week. You actually had everything was you saw a pickup in the number of bears and a fall off in the number of bulls, but it wasn't to the point where you went everybody they're bailing on this thing. They were still kind of holding it up. You did see short interest go up as September was ending. That was NASDAQ short interest was up about 3%, which is that's a pretty good bump up in that. So they were shorting in September, in mid-September. I take that back. We'll see what they were doing here at the end of September, probably in the next week or two. Still had outflows coming into equity funds. We had 10.9 billion left the market last week. That was on top of 7.8 billion the week before, and we're down now to only 12 industry groups were rated out of the 91 that we follow were rated either strong or improving. So that's not much, and it's no surprise what the strongest were: coal, oil field integrated majors, oil secondary, and oil field equipment. So it's a very small group. Energy was the only sector that was able to pull out a positive post last month, and it's not surprising. That's still where you're seeing that sector hold up the most. So I am bearish, and I don't see anything turning around, especially with today's action. But so I would say that our market posture is bearish. We'll just see how this thing trades, how low we're going to go. But as you can see by the targets that we set up in the letter last week, the Dow's getting close. It's still got about 250 points possibly to the downside, and the S&P 500 still has about another 80 or about. Actually, take that back. It only has about 25 more points to hit that 200-day moving average. So keep an eye on those. Again, if we can bounce along that support level, maybe this is overdone to the point where we can start to see some nibbling away, and if we can get some data where all of a sudden it shows as a September CPI and PPI start to come out, and we have a big jobs report on Friday with the governments, and we have the ADP I think tomorrow. Maybe if you see some numbers that could bring rates down, we could maybe start to see some short covering. But until we see something like that, You just need to stand by when the market's doing this and wait. You don't need to be a hero and step into this thing. As I mentioned last week, this is not a market that you want to step in front of and nibble away.
Do you think there are any places in the market that are maybe some bright spots or some hopeful spots given how bearish you are across the board?
Well, I did mention the last couple of weeks that again, and you can find this on Talking Heads. Some of the big bond guys. This is the best chance for you, especially if you're nearing retirement age, to get a decent return on some fixed income assets in decades. And I mean that sincerely. And some of these treasuries, they're going to be tax free in some states, depending where you are, and also some of your income. I would be, putting some cash to work on that. If you can pick up 5.5, 5.75, for a year or so, going out there, maybe even 2 years, depends on whether or not we go into a deep recession. If you see us starting to go into a recession, or you start to see, the market fall off because things are really slowing down, maybe you can go back into it. But there's no reason not to be buying some treasuries at this point. Maybe look at some other fixed income assets, because again, it's been decades since you've had a chance to do this, and that's going to protect your money. When the market goes down like this, one of the things you want to do, rather than looking at jumping in and saying, "Oh, I'm going to buy the sell off and make some money," this is when you want to protect your cash. You want to protect your assets and not just give them up. I mean, because you could have something like where if these rates break the market, I mean, you could have another 20-25% drawdown in the stocks. I'm not looking for that, but you could still see maybe at least another maybe 8 to 10% drop off. And you don't want to do that, and then it takes another 6 to 8 months coming back. As I mentioned earlier, the Dow's already negative for the year as of today, and that's on top of a negative year last year. So just the fact that if you could have made 5.5, 5.75% on some fixed income over the last year or so, you'd be pretty happy right now, rather than giving everything up. So that's the only thing I would be doing at this stage. And then, as always, we'll start to read the Friday market letter, and we'll start to look for signs of maybe some positive divergence. But we're very oversold. So you may get these little bounces off of different readings. If the SRO, the S&P oscillator comes in where we're down like 8 and 9%, you are going to have some people jump in there for a trade where maybe they can, the market opens up, 250 points and it feels the hole as it rolls over. But the active traders, may be looking at things like that for some day trades. But for the majority of us, go ahead and nibble away at those high rates on the treasuries, and I'd be happy with that.
Sounds good. Well, thank you for sharing, David, and we will look forward to talking to you next week.
Okay, sounds good. Have a good week.
You too. If anyone has questions for David or anyone else on the MarketEdge team, feel free to reach out to us at support@marketedge.com or use that chat now button in the lower right-hand corner of your screen. As always, your first 2 weeks of MarketEdge are free, and we look forward to seeing you there. Thanks so much. See you later.